What do law firms and claimants need to know about the litigation funding market in 2023?
So the litigation funding market has expanded in various ways over the years. And there are different types of funders looking at different types of cases. So, you have everything from the large investment funds or hedge funds, multi-strategy funds that have a certain allocation to litigation finance claims. You have private family offices who have put together a strategy to fund litigation. And then you have a lot of, well, of course, you have the listed funds as well, the likes of the Burfords and the Omnis, etc. And then you have a lot of other platform funds, the likes of Deminor, the likes of Harbour, and so on and so forth. So you have a number of different types of structures that exist out there, which have their own appetite in terms of types of cases. Some are focused on pure vanilla commercial litigation, others focus more on collective actions, and there's others that only want to look at secondary market transactions, and there's some others that will look only at things like asset judgment enforcement or asset enforcement type claims. So you have in terms of the types and sizes of cases, again, you have some funds that will look at claims worth hundreds of millions, and there's other funders that will be happy to look at claims worth as low as 5 or 10 million. So there's an entire spectrum of litigation funders out there that exist in the market, and for any given type or size of case, the geographical location, the jurisdiction, assuming the case is meritorious and it meets all the other relevant factors, i.e. there's a path to enforcement recoverability, the legal merits are sound, and the budget is proportionate to the amount of damages at stake, you can usually find a home for it.
Following PACCAR, there's been some change in the UK market. I don't know if you've seen different kind of levels of interest from different funds or different case types becoming more or less prevalent in the market, but are you able to comment at all on that?
Yeah, I mean, I think PACCAR was, an unwelcome and is an unwelcome distraction, I should say, to put it mildly, for funders and claimants alike. We've certainly seen funders, particularly those US funders, who at the moment are just not looking to fund or looking to invest in UK claims, which is a shame, because before the PACCAR decision, we found that there was quite a healthy market for these sorts of cases from US funds. So I think that's changed, and I think there's depending on how, and we know there's things going on in the background at the moment in relation to PACCAR, which may well change that, but certainly there's a degree of reticence from US funds, and just generally litigation funds at the moment are looking quite carefully at their books, looking at their existing exposure, and considering whether or not they want to really be funding certain types of claims. So I think competition claims at the moment, people are thinking quite carefully about. But on the whole, for good cases, there is still a healthy market of funders out there willing to invest in those cases. But for sure, PACCAR has added an uncertainty that was pretty unwelcome and needs to be resolved.
Agreed. And I think some claim types, so like the competition claims, are more difficult to restructure as a multiple, rather than referring to the benefit obtained by the claimant. So I think we'll see sort of continued caution until a time when the government takes some steps to clarify what's happening in the law at the moment. Second question, how is the insurance market responding to mitigate risk in disputes?
So AT insurance, after the event insurance, I think most claimants, litigators, and funders will be familiar with. So after the event insurance exists to protect a claimant from the risk of having to pay opponent's costs in the event of a loss. A to E as a product has expanded over time to, for example, include things like disbursements and also to include own costs. So there are, numerous insurers now who are willing to consider not just covering opponents' costs in the event of a loss, but also the claimant's own legal fees. So what that means is law firms can be more creative about the types of structures that they offer their clients when they can say, for example, we will be willing to act on a partial CFA, whilst usually the CFA amount would be fully on risk for the law firm, which could be, a bit of a cause for concern for them if the case goes, particularly long. They can now, as a firm, hedge that risk or a proportion of that risk. And similarly, as a claimant, there's all sorts of instances where funding isn't suitable for a case. Quite often, if it's not economically viable, if it doesn't sustain a typical funder's return. And in those scenarios, a client can say, well, look, we will fund the case with our own money, without using our own cash flow, but we still would like to have some degree of downside protection. So having own costs insurance to protect against a loss, I think is something that we're seeing an increase in demand for. So after the events insurance as a product has expanded out to include own disbursements and own costs. Anti-avoidance endorsements or deeds of indemnities are frequently deployed now in cases where security for costs is likely to be an issue. So we see that not just in commercial litigation, but also increasingly in arbitration now, where respondents are more willing to make security applications. Aside from after the event insurance, there's a number of other products out there that we're seeing an increased take up on, for example, cross undertakings in damages insurance. So this is where in scenarios where a freezing injunction is going to be obtained or going to be sought. And as part of that application, a cross undertaking is required. Now, that cross undertaking could theoretically be a significant risk to the applicant, and a way to try and manage that risk would be to obtain a cross undertakings and damages insurance policy. So in the event that the cross undertaking is called upon, the policy is there to provide some protection to the applicant. Another product that we're seeing increasing use of is judgment preservation insurance. So this is really a contingent legal risk market product. And this operates in, simply where you have a judgment or a first instance award, and you'd like to protect against the risk of that being overturned. There is a healthy insurance market out there that will provide cover for a significant proportion of those damages. So I think that's something that we've seen a lot of use of in the States. There's been less use of it in the UK, but I think that's mainly down to a lack of education, and also the markets that exist haven't spent a huge amount of time in the UK market, but I think they're now more willing to do so. So I think those are some of the products that we see, and of course capital protection insurance, which is similar to own costs, but it really operates for litigation funders in the main, or investors who are investing in litigation funds at a fund level, or indeed on an individual case or on a portfolio basis. So capital protection effectively, kind of says what it, means what it says on the tin, sort of thing. It provides you with the investor with downside protection in the event that the capital is lost for a particular investment in a case or in a portfolio or in a fund. So I think there's a healthy market at the moment for insurance products in litigation finance, and hopefully that will remain.
So what do law firms and claimants need to present to insurers to get a quick offer of cover?
So the same things that they would provide a funder typically. So, there'll usually need to be some sort of assessment on the legal merits of the case, whether that's done by an independent barrister or whether it's done by the law firm. something setting out what the facts of the case are, the various causes of action, what damage is likely to be. So I think a legal assessment is kind of quite an important part of the puzzle. If there's going to be any expert evidence or any other factual evidence that's going to be needed, quite often that's not done very early in the case, which is understandable, but to the extent that it exists, I think that's pretty important. And having an understanding of what the likely damages and cost position is going to be. So, as long as the ratio that funders typically look for, that 10-to-1 damages to costs, that's more like 2-to-1 where insurers are concerned, but they would still want to know that there is enough fat in there for the claimant to walk away with a healthy amount, and for the insurer to make their deferred and contingent premium. And finally, this is something funders spend a lot of time focusing on, insurers less so to a degree, but there will still need to be some assessment of the creditworthiness of the opponent to ensure that in the event of a win, a recovery is going to be possible.
And what's the benefit of using a broker to source insurance or funding rather than going direct?
I think the number one benefit is, I think it's just ease. To approach multiple markets, firstly to understand who the appropriate markets are in the insurance field or in the funding field, understanding their respective appetites, their internal processes, I think is a challenge for anyone, even an experienced litigator or claimant that has knowledge of the funding space or the insurance space and has done deals before. As a lawyer, it's not your day-to-day job to broker insurance and funding, and it is very time consuming. So having a sophisticated intermediary who does know all of that and has the ability to execute deals, who can take that burden off your plate, so to speak, is, I think, of huge benefit. It also gives you, it demonstrates to your client that a proper market process has been conducted. So it's not just a case that, it's just one funder or one insurer that's been approached. We are required to carry out a fair analysis of the market as far as insurance is concerned. And we take a very similar approach to funding, even though it's an unregulated space. We treat it very much in the same way. So, and then of course, once you can convince a funder or an insurer to invest or insure a case, it's assisting with the contractual process, assisting the lawyers and the claimants with guidance on what is market and what is not, what is approach, what is acceptable and what is not, and finding ways to overcome the inevitable obstacles that happen when you're trying to close a deal and the kind of transactional angst that occurs. I think a good advisor, a good broker will be able to help cut through the issues and ultimately get the deal to execution, which is the name of the game. Given that less than 5% of all cases that a funder receives are is successfully funded, being able to get to the nub of the issue, and understand a funder's appetite and then drive the deal to execution, I think is of huge benefit to lawyers and their clients. And then finally, once a deal is actually secured and contracts are signed, staying as a point of contact throughout the lifetime of the case to deal with those inevitable issues that occur, whether it's budget variations or applications being made which no one had anticipated, etc. Ultimately, law firms have a duty towards their client. Funders have duties to their investors. So whilst everyone is aligned in the sense of trying to get a successful outcome, they do have their own respective duties, and they are duty bound to look after them. So it's our job to kind of keep everyone honest and make sure that everyone behaves in a way that's conducive to a long-term relationship, because even with the best will in the world, most litigation takes several years. So it's important that that relationship is maintained properly.